You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
So if you've ever felt like you're just caught in this whirlwind of global news, currencies shifting all over the place, commodity prices jumping because of some distant conflict, trade spats over microchips, political tremors, it really feels like everything's interconnected, but honestly, it can be overwhelmingly complex. Today, we want to give you a focused deep dive. Think of it as a shortcut to understanding the really critical global market and geopolitical movements that are shaping things right now.
Yeah, our mission here is to cut through all that noise. We're pulling out the vital nuggets from this comprehensive global markets briefing that we get. It covers, everything. FX, commodities, trade, geopolitics. We're here to help you get up to speed fast and spot those key things you really need to watch.
Exactly. Think of us as helping you navigate. We're not just listing facts. We're connecting the dots, showing the ripple effects, exploring why this stuff actually matters, getting that bigger picture perspective. It's about understanding the underlying currents, not just the surface waves. All right, let's unpack this then. Kicking off with currencies and central banks, it's always a bit of a turbulent world there. What's really driving the U.S. dollar at the moment? And what about the contrast we're seeing with, say, the Eurozone and the U.K.?
Well, the U.S. dollar is, interestingly, pretty steady right now. Everyone's basically waiting for this critical Federal Open Market Committee meeting. That's the FOMC. Their decision is sort of the anchor for where broad FX direction goes next. But what's really fascinating is the divergence we're seeing pop up among the G10 currencies, the Big Ten.
Divergence, okay.
Yeah.
So different central banks are seeing their own economies quite differently then. What's the story with the ECB and the Bank of England?
Yeah, exactly. For the ECB, you've got officials like Nagel and Kocher, and they're sounding, distinctly cautious about cutting rates further. And that's not just talk, it's actually providing some real support for the euro. It signals maybe they're less eager to ease policy than markets thought, maybe worried about sticky inflation or, underlying strength. Then across the channel, the Bank of England is widely expected to just hold rates steady. So market attention there. It's totally shifted to their forward guidance. What signals are they going to give about the future? It's often more about parsing that language than the immediate decision itself.
Right. The market's already trying to read the tea leaves for what's next. Yeah. Okay, and what about Asia? We often see some unique dynamics there.
Absolutely. USD-JPY, so dollar-yen, it drifted a bit lower while Tokyo was closed. But the big thing for yen sentiment coming into view is Japan's LDP leadership race, the Liberal Democratic Party. Chief Cabinet Secretary Hayashi is expected to throw his hat in the ring, and Takaichichi is still polling well. But what's really underneath this race? It isn't just about who leads. It's potentially a signal, about Japan finally shifting away from decades of super loose monetary policy.
So the leadership contest is kind of a proxy for a bigger potential shift.
Exactly. A foundational shift in global capital flows, potentially. Not just yen sentiment. Elsewhere, the PBOC, China's central bank, they kept leaning against weakness, set the US DCNY fix stronger than the market expected, and that strength actually helped the Aussie and Kiwi dollars hold a bit firmer, even with some softer Chinese data. And interesting geopolitical economic link here, South Korea is talking to the US about limiting FX spillover from US investment packages. They're even discussing an FX swap framework again.
An FX swap. So like a safety net for liquidity.
Precisely. It lets central banks swap currencies to manage volatility, keep markets smooth during stress. It definitely highlights some underlying concerns about financial stability.
So that's a perfect example, isn't it? How domestic politics, like that LDP race, or even the need for a swap line, has these immediate real effects on global markets. Shows FX desks aren't just looking at rate differentials. They're parsing every signal, every political twitch, because it all feeds into risk and stability.
You got it. It's this complex tapestry. Domestic politics, financial plumbing concerns. They cast a long shadow immediately on global markets.
Okay, so from those invisible currency currents, let's pivot to the tangible stuff. Resources. How are these geopolitical bits and policy choices playing out in energy, metals, that sort of thing. The briefing suggests some real movement.
Yeah, definitely. Crude oil is actually firming up a bit. That comes after the U.S. hardened its language on Russia. Washington's been floating tighter sanctions, maybe linked to getting allies aligned, possibly curbing European oil purchases. It just tells you, geopolitics is still a huge, unpredictable driver for energy prices, always injecting that risk premium.
And the supply side sounds like a real mixed bag from the briefing, like countries pulling in opposite
A
directions.
very mixed bag, yeah.
Yeah.
It really speaks to different national strategies. So you've got Iraq signing a deal with Total Energies and Qatar Energy LNG that could boost medium-term supply, bring in investment. Egypt also secured 3 new upstream deals, over $121 million, so investment there too. But then, flip side, Ecuador is taking a totally different route. They're withdrawing their diesel subsidy to put money into social programs.
Interesting. So that's a domestic choice with potentially wider ripples.
Absolutely. It's this microeconomic shift, but with macro-political undertones. Shows the pressure on developing nations to reallocate funds amid price volatility. Could even set a precedent, Might surprise commodity prices down the line if others follow. So yeah, each of these announcements, they all shape that medium-term supply-demand picture for energy.
So not just isolated news items, they all feed into the global puzzle. What about precious metals? Gold often acts as that anxiety barometer, right?
Gold's looking pretty choppy ahead of the FOMC, still hitting resistance around that $3,660 level everyone watches. The market's basically weighing 2 scenarios. A hawkish Fed inclined to keep rates, higher risks, a pullback. Higher rates make gold, which doesn't yield anything less attractive.
Right.
But a more dovish Fed, signaling lower rates may be coming. That could push it towards, say, $3,700, maybe $3,800. So again, the Fed casts a long shadow. But the mood is really just nervous wait and see. Reflects that broad uncertainty out there.
And industrial metals. Copper. Dr. Copper, what's it telling us?
Copper edged up a little, but it's being held back by some of those weaker activity numbers out of China we mentioned. It just shows how critical China's economic pulse and industrial demand are for global commodities. Acts like a ceiling, even if other things push prices up. It's a key sign of global industrial health, or lack thereof.
Yeah, connecting that bigger picture, you really see how a policy choice in, say, Ecuador or U.S. rhetoric on Russia, it directly hits commodity prices and supply chains globally. It's also intertwined.
Truly is. A political move in one capital can send ripples through oil markets, metal exchanges worldwide. Understanding those deeper links is really key to grasping market moves, not just reporting on them.
Okay, moving from barrels and ounces to, well, tariffs and apps. Global trade is always buzzing. The briefing highlights some pretty intense movements, especially U.S.-China. What's the latest there? Tell us about where that relationship is heading.
Well, the U.S. and China did get back to the negotiating table in Madrid, covered those hot-button issues, TikTok, broader trade stuff. But reports suggest pretty limited progress on tariffs and, interestingly, fentanyl. So that lowers the odds, unfortunately, of a near-term summit in Beijing. Instead, the focus seems to be shifting. Maybe a more modest meeting between Trump and Xi around the APEC summit in South Korea next month.
APEC, right. Asia-Pacific Economic Cooperation. So dialogue continues, but breakthroughs seem tough.
That's the takeaway. Dialogue, yes. Big breakthroughs, elusive. The relationship is still marked by these really deep-seated tensions.
And Beijing isn't just waiting around, right? It seems they've hit back, particularly on tech.
That's right. Beijing launched fresh anti-dumping and anti-discrimination probes, specifically targeting U.S. analog chips. It directly mirrors U.S. measures against China's IC sector integrated circuits. So this isn't just tit for tat anymore. It really signals a deepening tech decoupling, a strategic fight over critical components.
Wow.
And Washington also added 32 more entities to its restricted trade list. 23 in China, the rest scattered across India, Iran, Turkey, the UAE. Shows a broader strategy of control, really, beyond just direct rivals.
And domestically in the U.S., the language stays tough, based on the briefing. Feels like almost every bit of tech, chip, or app is now a potential bargaining piece.
Absolutely. You hear the administration claiming China is paying a lot in tariffs, keeping the pressure on TikTok, asserting NATO will impose steep tariffs on China while the Russia war goes on. That kind of talk keeps corporate planning very cautious, especially if you're linked to China. It implies companies just can't separate economics from geopolitics anymore. Supply chains, R&D, market access, it's all tangled up with national security now.
It's not all tension, though. The U.S. and U.K. seem to be moving fast on some deals, almost a contrast to the U.S.-China vibe.
Yeah, good point. By contrast, the U.S. and U.K. are racing to finalize deals. Nuclear reactors, AI data centers, even whiskey. ahead of the president's state visit. Plus, there's talk of a groundbreaking tech accord. This flurry of activity just underlines how alliances are strengthening even as rivalries sharpen. It points to a more fragmented global trade picture where, trust and shared strategy drive cooperation.
It really raises that question, doesn't it? What does this mean for companies trying to navigate this? Where chips and apps are basically instruments of state policy. It's a totally different world than even 10 years ago.
It means they're facing a highly fragmented, politicized landscape. Supply chains, R&D, market access. They're not just economic calculations anymore. They're deeply tied into geopolitical strategy, national security. The why behind these actions against chips, apps, it's often about keeping a competitive edge, projecting power. And that has huge implications for how companies have to plan and operate globally. Strategic foresight, adaptability, they're crucial now.
Okay, let's zoom out then.
Yeah.
Broader geopolitical landscape. The briefing flags, a few key flashpoints, diplomatic moves, Europe, South China Sea. These aren't just headlines. They create real market risks.
For sure. Starting with Russia-Ukraine. Washington's signaling it's ready to ramp up sanctions on Russia, though it depends on allied alignment, European energy choices. G7 finance ministers are talking about using those mobilized Russian assets' frozen funds to help Ukraine. New tariff tools being mentioned, too. On the ground, Ukraine claimed a strike on Russia's Kirishi refinery. Poland and Romania even scrambled jets after drones got near their airspace.
Wow, close calls.
Yeah, stark reminders of the spillover risk. For the region, and crucially for European economic sentiment, the euro's stability.
And the Middle East, always volatile. Several things creating a complex picture there.
Indeed. An Israeli strike in Qatar definitely raised diplomatic temperatures. Doha warned it undermines de-escalation efforts. Though mediation with Egypt and the U.S. is still going on that constant push-pull, conflict and diplomacy, Hamas also suspended prisoner swap talks, accusing Israel of targeting negotiators. That could obviously complicate any path towards calming things down. And there's this latent risk for oil markets. Iran warning that if the EU snaps back UN sanctions, it could jeopardize nuclear monitoring. Just a reminder that stricter sanctions could disrupt oil supply, even if it's kind of a background risk for now.
Okay, shifting over to the Indo-Pacific. Sounds like a mix of military drills and diplomacy happening side by side. A real balancing act.
Exactly that. The U.S., Japan, Philippines held joint maritime drills in the Philippines' EEZ, their exclusive economic zone, that sea area where they have special resource rights. At the same time, China ran what they called routine cruises in the South China Sea, told Manila to stop provocations.
Tensions remain.
But diplomacy is ongoing. South Korea's foreign minister is heading to China. Australia and China are holding high-level talks in Beijing. There's even talk of Xi possibly visiting South Korea. So it's this dual strategy. Assert interests militarily, but keep talking at high levels. That's really typical of the Indo-Pacific right now.
And even a small incident closer to home for the U.S. in the Americas reminds us even minor things can matter.
Yeah, Venezuela protested after a U.S. Navy destroyer intercepted a Venezuelan tuna vessel in its EEZ, called it a security risk. Now, it's small on its own, but worth watching. Could potentially impact energy shipping insurance costs, that extra premium for high-risk areas, and just general regional friction. It's like even a tuna boat dispute can be a tiny spark in a bigger, potentially flammable geopolitical situation.
What's really striking is how that diplomacy is happening right alongside the military stuff, the tensions. Constantly trying to balance stability with pushing national interests.
Yes.
These aren't isolated dots on a map. They're deeply connected to market stability, investor confidence.
That's the absolute key takeaway. These flashpoints, they create risk premia, uncertainty, right across global markets, even things that seem regional. A fishing boat protest, drones near NATO airspace, they can have global effects, influence energy prices, currency sentiment, risk appetite. It's this constant, delicate dance that traders, policymakers, everyone has to watch.
Let's quickly touch on some specific regional things influencing that broader picture, too. First, Europe.
Okay, Europe, mixed signals on sovereign risk. Fitch cut France to A+ up, stable outlook, but they lifted Portugal and Spain. FX desks are looking at this through the lens of fiscal trajectories, the long-term health of budgets and debt, not just immediate rates. Politically, in Germany's North Rhine-Westphalia state, the CDU led exit polls. But critically, support for the AfD, the alternative for Germany, tripled. It's another data point showing that political retilting in Europe. Growing nationalist sentiment, potentially more fragmented politics, that makes unified EU policy trickier.
And the UK. Some policy news there influencing sterling even while the Bank of England stands pat.
Yeah, the UK government flagged VAT relief on energy bills, unveiled over £1 billion in maritime investment. London also announced over $1.25 billion in U.S. finance, FDI foreign direct investment, and a multi-billion trade pipeline linked to that upcoming state visit. So these policy currents, even with the BO on hold, they feed into sterling risk premia, that extra return investors want, signals fiscal priorities, potential growth drivers.
Okay, hopping over to China. The macro data looked a bit wobbly, causing some ripples.
Indeed. China's August activity was disappointing. Industrial output, retail sales, fixed asset investment all softer. Unemployment ticked up. Home prices fell again. That signals ongoing challenges in the world's #2 economy, hits global demand.
But Beijing's trying to sound supportive.
Yeah, their messaging leans supportive. Talk about expanding domestic demand, stabilizing jobs, adding property support. That guidance helps maybe temper risk aversion in Asian FX, but it's not enough to reverse it without more decisive action. Shows the fine line they're walking. Support growth, but manage systemic risks.
Connecting this back again, you see how these regional shifts aren't isolated at all. They're crucial pieces of the global puzzle. Ratings, politics, local data, they directly hit global currencies, market sentiment.
Absolutely. The euro's performance is tied to fiscal paths in Paris or Madrid, politics in Germany. China's data hits global exporters, supply chains. Every regional piece feeds into the whole dynamic, shows just how deeply interwoven economies are now.
So wrapping this up, what does this all mean for you trying to navigate the news, make sense of the world? We've covered a lot of ground today, seen how everything from central bank speeches to, well, tuna boats plays a role. We've seen diverging central bank policies hitting FX, that complex dance between geopolitics and commodities, the deepening U.S.-China tech and trade rivalry, and all those ripple effects from regional political and economic shifts. It's a lot in motion.
Yeah, this deep dive really highlights how things that seem totally separate, a leadership race in Japan, an oil deal in Iraq, trade talks in Madrid, they're all connected. They're constantly shaping the global economic political landscape, creating this really dynamic environment that, frankly, demands attention and understanding beyond just the headlines.
And as we finish, here's something for you to think about. Given these constant shifts, central bank guidance changing, trade relationships blurring economic and geopolitical lines, all those hotspots we talked about, what emerging dynamic do you think might be the biggest surprise factor for global markets in the next 6 months? After this deep dive, what's the one signal you'll be watching most closely? Keep those thoughts brewing. We look forward to connecting with you next time on The Deep Dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.